Welcome to this episode of Conquering Your Financial Future. My name's Gavin Glosier. I'm your host, the co-founder and director of Your Wealth Hub. Today we're joined with Clint Abraham. Clint, great to see you. Clint is the portfolio specialist with Morningstar Investment Management, and today we're talking about investments in the year that was. So we're going to kind of pick your brain, Clint, around what happened in the last 12 months. We're going to go through and try to understand, if you're looking back, particularly if you're getting your investment statement for the last 12 months, what are you likely to see as the result of the last 12 months? We're going to try to understand if there's been anything that's kind of changed the trajectory of what you would have been earning, and also look ahead for the next 12 months as well and see what we've got in store. But Clint, you're in the hot seat today, so we'll kick off with a nice curly one. Your thoughts on the last 12 months? How has the market generally performed?
Well, it's been a really interesting period, and from our point of view, it was really the tale of two halves. The first part of the financial year, so the last part of 2017, was actually quite a strong period for markets, particularly global equity markets. Sentiment felt very good for investors. There wasn't a lot of volatility. But really, as we came back from Christmas into 2018, we did get quite a bit of volatility come back into markets. And really, over the course of the 6 months of this year, returns in a lot of the key asset classes have actually been quite subdued.
Compared to what was the first half,
Absolutely.
as you say. So, did we think, or did we expect to see this type of volatility in January? Was that something that the market had priced in? What's your thoughts there?
I wouldn't say that it had priced in. In fact, volatility throughout the course of 2017 was actually quite low, and we can measure that with the volatility that's being priced into the options market, particularly on the Chicago Board of Exchange. And really, it's a way of gauging how much fear investors are pricing into markets, and that was historically quite low throughout the second part of 2017. And that's really suggestive that investors were getting a little bit complacent towards the end of 2017. They're really thinking that the strong returns that they'd seen throughout much of that year could really be projected forward, and that was a view that we didn't share. It's normal to have volatility in markets, but trying to understand the timing and the catalyst for volatility is actually very difficult. And so what we saw in the start of this year was there were really two key reasons that saw volatility come back into the market. The first was confirmation of rising US interest rates, and as you might recall, we had a new Fed chair join in early 2018, and really following his first meeting, as I said, the path for rising US interest rates was reaffirmed, and that has big implications for the way that investors value both bonds and share markets. And the second thing was just a general escalation in the global political world, if you like. There was backwards and forwards with North Korea, obviously, and really an escalation of the trade tensions led by Donald Trump. So
it's quite an interesting. It seems to be a lot of that volatility actually came from US.
Very much so.
Which is quite interesting. And we'll talk a little bit about the interest rates in a moment, but I think from my perspective, I was really interested outside of where the volatility came from. Was there anything that kind of took you by surprise in the last 12 months that meant that the course of the market did take an alternative route? I think what actually was the timing of that volatility. So we were really quite cautious at the start of the financial year. It's a view that we share now. We think that valuations in share and bond markets are really quite expensive. And so we had that 6-month period where it felt like plain sailing. Investors were very keen to get into markets. We had sentiment really driving markets, and that's quite common. When it feels good to invest, quite often you can see share markets in particular rally quite strongly. And from our point of view, we felt that had drifted away from what the valuations and what the much so, and what the fundamentals of those asset classes suggest that it should. And so then there was obviously the snapback in volatility in the first part of the year, which again, it's a surprise when it happens because it's very, very difficult to predict, even though that we felt that more cautious response by investors. Yeah, absolutely. And do we feel that the market has contracted to a point now? You mentioned 6 months of kind of okay returns. We haven't seen that kind of bull run as such.
Yes.
Do we think the market's going to come back a little bit and probably better fair value, or we think it's still a little bit higher?
The answer is that it's quite selective. So there's certain markets that we think are more attractively priced. Emerging market shares, Japanese shares, UK shares, again picking up on that sentiment theme. The fear and uncertainty around what Brexit might bring, given that there's still ongoing negotiations, has weighed on UK shares for a little while, notwithstanding that they've ticked up a little bit lately. But that's where we can see the valuation, the more attractive valuations. Things like US equities we find really quite unattractive at the moment. And that's really a function of, I guess, a lot of the central bank policy action that we've seen since the GFC. Australian shares too we actually find generally unattractive.
Have there been any segments of the market that have performed quite poorly that may have surprised you, I think, in the last 12 months? Has there been any areas that you've kind of thought, okay, that was not really expected? What's your thoughts there?
Yes, when you look at the I guess the sector analysis of global share markets, there's two that kind of stand out. One on the positive side, which is the information technology,
the FANGs,
the FANGs,
style,
and not just the FANGs, but also the Microsofts and the Oracles of the world, but very much the FANGs. They're very much in the news.
I want to get this right here: the Facebook, the Amazon, the Netflix, and the Googles.
Correct.
Excellent, very good. The S on the end, that's not Snapchat, is it?
No.
That's
a good application.
Could absolutely be. Okay, good. So the tech stocks have been the positive, you're saying?
Very much so, and also not just in the US. They're obviously the ones that we know about, but in other emerging markets like the Tencent and so forth in China and other places. But really, so that they had a very strong period, really very strong gains. What you've seen on the other side, though, is that telecommunications have been left behind. And so if you think of those sort of businesses, it's not just Telstra, but it's very much a global theme where they need to change their business model to adapt to the way that we as consumers are consuming data and those telecommunication services. And that presents some challenges to them. Notwithstanding that they are very, very high quality businesses and they're very cash generative.
So traditionally they've always delivered strong dividends, which people have been pretty impressed with. So you're thinking that's going to change and they're going to be more growth oriented as opposed to dividend oriented, or what's the thinking there?
Yeah, I think it's more that they need to change their business model to adapt to where consumers they need those services to be provided. And what you often see is that wherever there's a little bit of uncertainty, and this is applicable as much for a stock like Telstra or indeed an asset class like we're talking about telecommunications or indeed other asset classes, wherever there's a little bit of fear and uncertainty, there's a behavioural response in all of us as humans that tends to want us to leave that asset because it feels uncomfortable to invest. We don't like to see that sort of uncertainty. And what happens in that process is that quite often we sell the asset and we lose track of the difference between price and fair value. So effectively we sell at any price just to get out of that asset and to make ourselves feel a little bit more comfortable about the situation. However, that actually is one of the best opportunities to buy because effectively you can buy something cheaper than what it's worth. And if you are, if you do have the belief that these are higher quality assets, as I was touching on, for telecommunications, generally very high quality businesses generating huge amounts of cash flow. If you can buy and hold for those through that sort of near-term period where they are experiencing headwinds, often that can be quite a good investment.
So listening to my taxi driver this morning about jumping into certain stocks that perhaps look really attractive now still isn't the right way of going about selecting stocks. It's really about perhaps when everyone else is kind of thinking of buying in, it's probably a good time to exit for that reason about fair value you're talking about.
Yeah, well, very much so. I mean, Warren Buffett has a saying which I'll paraphrase, which is to be greedy when others are fearful and fearful when they're greedy. And really in our view, the best valuation opportunities come up when nobody else likes them and they're just selling to get out of that. And again, I touched on some key areas that we find attractive at the moment, which are things like UK equities, which are generally have underperformed given the weight of negative sentiment around Brexit. Emerging market assets like in both shares and bonds, which sentiment is boding poorly against them given Trump's protectionist policies are seen to be good for the US dollar and the US economy at the expense of some of those emerging market nations like China. And really the challenge for us is while we certainly can't predict macroeconomic events. It's very difficult to know what Trump's going to do or what central banks are going to do. The challenge for us is to understand what's actually in the price of an asset. And we do a lot of work around understanding what the cash flows are like, either dividends from bonds or dividends from shares or coupons from bonds. And there will be a price where you are getting compensated for the risks that are present to the asset.
Yeah, okay. Well, let's just wrap up 2017-18 before we look into the crystal ball about what's ahead.
Sure.
If people are opening their super statements or their investment statements for the last 12 months, which they will be absolutely doing over the next couple of weeks to a month, what do you think they're going to be seeing, and will they be happy?
I think they should be reasonably happy. If we, at the start of our talk today, we talked about the year being really divided into two halves. And so if you look at a relatively strong second half of 2017 and much more muted gains in 2018, I think portfolio returns will be somewhere around the average. So I think if you're a growth investor and you're getting returns of sort of mid to high single digits, I think you should be, I think it's a reasonable outcome.
Mid to high 7 to 9% roughly.
Yeah, anywhere sort of north of 5% I'd have thought would be a reasonable result. And I think if you look back at the start of this financial year, as I mentioned, we were generally, as investors, focused on the risk of losing capital and trying to avoid that situation. I think we were genuinely concerned that a number of these asset classes were not delivering expected returns that we considered fair.
Sure. And
what happens when you have low expected returns is that you have a greater risk of loss. And so, to deliver a positive return in that environment where there's no shortage of, risks on the horizon, I think it's a pretty reasonable result. Okay,
let's look ahead into the crystal ball. We talked a little bit about the US interest rates potentially going north, and quite clearly now that's happening.
Yes.
And we're seeing that play out across the global economies as we start seeing economies that have their underlying debt pinned to the US dollar. So what does that mean for investors? And let's talk specifically Australia. We've talked a lot about and heard a lot about interest rates from major institutions increasing before the Australian Reserve Bank increases.
Yes.
Why does that occur, and what's the impact and knock-on effect going to be with the US dollar? Interest rates, sorry.
US interest rates? Yeah. Yes, so you're right. The US Fed is clearly telling us that they are starting to continue on this path of rising interest rates. Now, that's not to say that they're going to get up to the higher levels that they've seen, but really that change in trend it has big implications for the way that we value share and bond markets. Now, from the US bond is really the benchmark for how global bonds are priced, and so that does feed into Australian bonds, and that presents a bit of an interesting dilemma because it really feeds into the longer part of the longer dated securities on the Australian yield curve. But the shorter end of the yield curve is those nearer dated securities. They're really dictated by the outlook for the Australian economy.
Sure.
And to an extent they're in sort of heading in opposite directions to what the US economy is doing. So the RBA is in a really challenging position. I would expect they're probably not going to do too much for a while, although they'll be getting pressure to hike. Lift their rates, but the local economic environment doesn't really support that. And obviously, Australians are hugely involved in residential property and so forth, and that appears to be cooling a little bit. The Australian dollar's fallen a touch, which will please the RBA.
And which will probably continue to fall as interest rates overseas increase as well, I'm assuming.
Well, that's right. We actually think that the Australian dollar is still a little bit overvalued, even though it has fallen a little bit. Now, the important thing, though, is that while it doesn't look like the RBA is going to be doing anything anytime soon, our banks get a large amount of their funding from offshore.
Sure.
And that is going to be leveraged to the rising US interest rates and so forth. So it's highly likely their funding is going to go up, and they're already telling us as much. So it's absolutely not out of the question that you'll see out of cycle rate rises.
Which is going to create a lot of concern amongst consumers not seeing the RBA increase their interest rates. So there'll be a lot of pressure on banks to justify their position, no doubt.
That's right, but they're absolutely passing on their funding, the increase in their funding costs. And Australians the Australian consumer is quite already quite leveraged, and so it'll be interesting to see how that plays out.
You mentioned before that last year was a tale of two halves. Looking forward into 2018-19, are we going to see much the same of the second half of the last financial year, or a bit of a bull market from the first half of the last financial year?
It's a really good question, because certainly we're in a much more cautious environment at the moment. As I made the point before, I think that caution is warranted. If we look at where equity and bond markets are valued at the moment, we don't think those valuations are fair. In many cases, those expected returns are quite a bit lower than we'd look for, and that opens up the risk of loss of capital. And so the timing again is very difficult to predict on when that might play out, where we might see some weakness in share markets that might give us the opportunity to buy again. But it does mean that we need to be more cautiously positioned. And so, our portfolios are generally holding a bit more cash, waiting for the opportunity to buy assets.
To buy good value assets.
Absolutely. We think about, it's a bit of an analogy like a department store sale. If you're going to get, or you hope that you're going to get the opportunity to buy something that's good quality, and you want to buy it on sale, and you want to hold on to it for a longer time.
Absolutely, buying the best assets at the best price.
That's how we're thinking about investing. If we think, again, we think about Telstra or Commonwealth Bank or some of those names that have been in the paper where they do have some issues going on at the moment. If we think that they are high quality businesses and they'll have the opportunity to work through them, then potentially what we have is a short window where they are on sale, and that's the sort of environment that we would typically like to buy assets.
Well, there's certainly been a lot of talk around that, and it would seem that we're closer to sale time than we are to boom time, so I think it's probably not a bad thing.
Yeah, so I think that the valuations and I guess the performance, particularly throughout 2017, suggested that markets were really getting close to being priced for perfection. And you have a look around what's going on in the world today, and the world is anything but a perfect environment. And so it's very, as I said before, it's very hard with sentiment, because quite often we can get very, very excited about markets and it feels like a good time to invest. But that can shift very, very quickly. And from our point of view, we really believe that anchoring your investment decisions to valuations is actually a really good way to navigate some of those tricky conditions. Are you getting a good deal for the assets that you want to buy? If so, you should load up and get as much as you can, so to speak. And if not, you just need to be patient and wait for that opportunity to buy something that's better value.
Okay, so let's wrap up with the last question. Tips for being a good investor. What should someone be doing who's looking to invest in the market right now?
Yes, well, as I said, we think the investment environment's actually quite challenging at the moment. We think that your returns going forward will be dictated as much by what you don't own as what you do. And so in that environment, you absolutely need diversification to help identify, to effectively spread your risk. You do need a process that allows you to go and invest in the best opportunities wherever they might be. And the last thing I would say is that there's an enormous amount of noise out there at the moment. But as an investor, just stay focused on what's important to you, your ability to achieve your goals, for your longer term objectives and so forth, and as applicable, reach out to experts to help you along the way.
Absolutely. And if you do have any more questions about investing or want to get involved in creating a diversified portfolio, please contact us. We'd love to help you achieve that goal and put you in touch with the appropriate professional to ensure your investments are well managed. Clint, thank you very much for today. Really appreciated having you in.
Welcome. Thanks for having me along.
Yeah, no worries. It was really good. I really got a lot out of that, and I think out of anything, the area that I'll be watching is certainly the impact of US interest rates and how that impacts so many people, so many Australians that have debt at the moment, particularly in the retail property market. So I think they'll be certainly looking to see how that plays out. Thanks for tuning in today. I hope you really enjoyed the episode. Thanks again. My name's Gavin Glosier, and you've been listening to Conquering Your Financial Future from Your Wealth Hub. Thanks a lot. Cheers.